You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, with our monthly check-in with Dr. David Erfle from JuniorMinerJunkie.com. Dave, welcome back onto Mining Stock Education. And in your most recent letter to subscribers, you have been adding to some positions, good positions you've already identified in the junior gold stock sector. And I was thinking about that in relation to typically, seasonally, we see around December 15th or thereabout, we get the bottom in the juniors with tax loss selling. But you're adding a couple weeks before that predictable bottom. Can you explain why, please?
Sure. I might be a little early, but, because we got the monthly close coming up here on Thursday and the gold price. And, for some fantastical reason, it always gets beaten down right below 2,000 on the very last day of trading, on the monthly, because the monthly close is so closely watched by momentum traders. And it's the gold price has been beaten down now below 2,000 in 8 of the last 9 months. Well, 7 of the last 8 months, and it's reached 2,000 here again in the 9th month. But I digress here as far as the stocks are concerned. If you take a look at the last 3 months, the trading in the GDX and the GDXJ, it's creating a bottom here. And if you take a look at the valuations, they're ridiculously undervalued in relation to the gold price. I've been harping on that for what seems like years now. But as far as the stocks in relation to the gold price, the juniors especially, they're really beaten down. And tax loss selling really began in April of May, the last 2 years, especially in the juniors. So sure, there might be a little more downside on some of the ones that I added to, but I see the upside as, the risk is really to the upside now. Because if you take a look at the volume spikes since the beginning of November, you see these huge volume spikes on up days, and on down days, you're getting half these volume spikes. And that is telling me that there's accumulation going on. Tax loss selling is drying up. Fund liquidations are drying up. The funds that we're going to sell for tax loss and quarter end book squaring, month end book squaring. I think most of that is completed now. That they're finished, and it looks like a lot of the tax loss selling is finished. Each junior will bottom on its own volition. They don't ring a bell when it all dries up. So it looks to me like the tax loss selling has ended in several of these stocks, and a good thing to watch as far as knowing, having an inclination of tax loss selling and fund redemption selling drying up in a stock is if you see a huge volume spike in a junior that normally doesn't trade with a lot of volume. You see a huge volume spike. And this is most likely, a fund redemption finally getting out, or tax loss selling just finishing up in that stock. And sure enough, you see several of these juniors that had these volume spikes. They've had strong moves to the upside since then. But look at the volume. That is a really good tell for if you're looking to start to scale into some of these things, because bottom fishing has been very dangerous for the past year. You keep averaging down on your accumulation, and they always go lower than you expect. But then on the upside, when it turns around, when that algorithm switch flips in this sector, and it can do so on a dime, even without a major catalyst, these things can move a lot faster than they went down. It's always better to be a little early, even 6 to 8 months early, than it is to be just a few weeks too late.
And as you mentioned to me previously, we've been in a multi-year bear market, except for maybe 2 mini bull markets of like 5 to 6 months in 2016, and then again in 2020, right?
Yeah, since the beginning of 2016, we've had two bull markets of about 6 months, pretty much, and followed by bear markets of about 3 years. So, the windows could be very short, but they could be very lucrative, because when they open, these things can run up, 5 to 10 times in just a few months. But you have to be patient if you're accumulating and wait for that move to happen. And, the gold price has been bumping up against that $2,000 level now for over 3 years. And each time it gets beaten down there, these anybody who's already in stocks get discouraged and sell for tax loss, and those that are sitting on the sidelines just say, forget it. I'm not going to bother getting into gold stocks right now, because the stock market's going higher. I can get 5% on my money just in the bank now. So why should I mess around with these high risk juniors? And if the majors aren't going anywhere, then the juniors certainly aren't going anywhere. So I'm just going to get out for tax loss, and I'll maybe take a look at it every once in a while, or see what happens when the gold price finally gets above 2,000. Then maybe I'll get back in. And I think that's already starting to happen with some of these stocks. These savvy investors, because that's basically all that's left in the junior space right now, is people that are familiar with the sector and professionals. They're the only ones left in this space, because the generalists left over a decade ago and they haven't returned. So we need them to get back in, to sop up some of these these gains that are taking place on Bay Street with these stocks, because it hasn't mattered really how good your drill results are. If you come out with bonanza, if you're an earlier stage company and you're coming out with bonanza grade results, and these professionals see how much money you have in the bank, and you've got less than 8 months, 6 months of capital, they know you're going to raise. They're going to sell your stock, after the pop of the bonanza grade results, and they're going to keep selling it, because they know that if they push it down low enough and they like what the company's doing, they can get into a private placement and get a half or even a full warrant. And now some of these full warrants are being offered for 3 to 5 years, and they can get in a lot cheaper and have an option to get a lot more at no cost to them. So that's what they're doing. And the retail speculator that remains in this sector, continues to watch their stocks go lower because of this. And these games are going to be continued to be played until somebody calls them on it, meaning investors come in and see the dichotomy, they see the undervaluation of these stocks. They understand that, hey, look, gold price is breaking out, and look how cheap these things are. I'm going to get in. And that's when that algorithm switch flips. And, these shorts that have been shorting these miners, and they've been forcing them down, they have to cover, because you have to cover a short to make a profit. And then all it takes is that switch to flip. It happened in 2016, the second week of 2016. I mean, the miners were kind of doing the same thing they're doing now back in late 2015. They were building this long base for about 6 months, and tax loss selling had ended. So, these speculators were getting into these stocks saying, wow, look, I mean, this base is being created. These things are really going to move, and they're going to move fast. But there was one more trick up its sleeve. We had a move down during the second week of 2016, a move down after building that 6 month base, sharp move down. It got a lot of people out of position that were accumulating stocks for the past 6 months. They're like, oh, it's going to be another move down. I got to get out. Well, it didn't even wait around for the next day to reverse. It was an intraday reversal. And then the index moved up. You had stocks go up 5-10 times within 6 months, and the people that were tricked out of their positions during that quick bear trap, they were just stuck watching, because they were scared to get back in, thinking it was going to reverse again. So that's what this sector could do to you. It can frustrate you no end. You're pulling your hair out, and you're accumulating these things, and they just get cheaper than you expected them to get, and then you give up, and it seems like as soon, almost to the day that you give up, it turns around. I've had it happen to me in the, in the past when I first started to get into this sector. But, that's what's great about this sector. It's basically, it's the most difficult and most frustrating sector in the world to make an easy living. Because if you get, even if you get close to that window, get in early and hold on, you could do really, really well in a short amount of time.
Dave, even during those like 3-year bear cycles that we've seen in the last 6-7 years that you referenced, there are cycles within that in which you can predictably make money. So for example, the season we're entering, like the second, third week of December, the next 60 days, you can usually do 50 to 100% in a stock in a junior. Do you ever play that seasonality in this sector?
I did in the past when it was just me, but now that I have a newsletter,
you don't want to create the market for a little junior.
I do not. Yeah, exactly. That's exactly right. I'm accumulating these stocks with my subscribers because I believe them to be undervalued, and I believe them to have 3 to 10 times upside potential within the next 2 years. And that's what I'm promoting, and that's what I'm doing myself. So, I'm not trading them. I'm accumulating. And that's the best way to make money, is you accumulate at the bottom. And what, of course, this bottom has taken a long time, because basically the mining sector, the GDX and the GDXJ, the major miners, the mid tiers, the royalty streaming companies, they bottomed last September. Okay. But the juniors continued to go lower. So the GDX and GDXJ are 35-40% higher than they were back in September of last year. But a lot of these juniors have continued to go lower, and many of them with really good projects and really good jurisdictions that are even close to the finance stage or at the feasibility stage. They're trading at their 2016, 2017 lows, or even some of them even lower. So, you accumulate a basket of these things, and all it takes is 1 or 2 of them to have that, 10, 15 times move. And you're going to do really well, even though you're going to still hold several clunkers that aren't going to go anywhere, that don't get the financing. That's the thing right now, is the capital. The capital markets have frozen up for a lot of these exploration companies. If you're not fully funded for next year, forget it. Your stock's being sit on right now. I don't care what kind of results you're coming out with. Your stock's being sit on right now. So, and it's very difficult to raise money in this environment. I mean, a lot of these companies, even with the great projects that are, that had a lot of buzz, at the recent conferences, people were talking about them. They announce a finance, and I talk with them at these meetings, and they tell me they're going to raise a certain amount of money at the end of the year. Well, it comes to the end of the year, and they announce a raise for half of what they intended to raise, and they have to attach a full 3-year warrant to try to get it. So that's how tight this sector is right now for money. So you have to be very, very careful, and you have to be very, very selective. But if you know what you're doing, like I think I do, and this is a good time to invest in a newsletter to try to help you to get into the right ones, because there's a difference between getting in at the bottom and getting into the right stocks at the bottom. Because when this algorithm switch flips again, I believe it's about to imminently do, like it did in early 2016. Maybe this time some of these companies won't start moving up with the quality companies because they can't get financed. When it happened in 2016, the finance window opened for everybody. So that's why a lot of these lifestyle juniors were able to hang around. Everybody got financed. But this time, and I'm hoping it doesn't happen, because a lot of these companies need to go away. So, it might be more selective this time on which ones of these stocks pop.
Dave, I had a listener write in and say, why are you speculating on all these small juniors? If you think you can get the cycle right, why don't you just buy calls and puts on GDXJ and not have the specific company risk. And I'm not going to, there is some thought to that, you know, but what would be your response to something like that?
Well, because I think there's more money to be made if you get into the right companies. And for me, it's a lot more fun also, you know, because, you know, that's what I do. You know, I talk because I believe in these companies, and, you know, I've gotten into good relationships with their management team. And I feel like, you know, if they're successful, I'm successful, and we're sharing in their success together. And, you know, it's more of a human thing. If you're just doing it to try to make money, then, you know, it's more of a robotic thing. And it's just, hey, I'm just, you know, I'm going to buy some puts, or I'm going to buy some calls or whatever. And I'm going to try to option trade this whole sector. You know, you're kind of by yourself doing this in a little room, and you're not out there interacting with the people that are actually, you know, going out, you know, in the bush and trying to go from discovery to feasibility, to construction, to production. That's very difficult to do. And if you could go along for the ride with them on a couple of successful ones, that feels really, really good. That's what life's all about. You know, it's not about just making money. It's about making money along with other people that have the same goal in what they're trying to do. And because you know, mining is extremely difficult. One discovery out of 3,000 becomes a mine. I mean, it's really, really difficult. So when it happens, it feels really, really good. And, you know, it's a huge sense of accomplishment. And if you put your trust and faith in the right people and go along for the ride along with them, you know, it's a lot more satisfactory.
So Dave, would you agree with those that say when you invest in one of these little gold juniors, you're essentially buying a call option on management, or maybe management and a project, because there is like the time premium and the expiry, because like you said, you could buy the stock at 80 cents and then it could get shorted and sold down to 10 cents where they recapitalize, and, you know, you didn't lose everything, but you lost near everything.
Yeah. I mean, you just have to, that's why you have to be on top of what they're doing and be on, because I look at charts every day of my life. Even on vacation, I'm probably looking at charts. So, you know, I follow these things really, really close. I'm really close with the management teams. You know, I know the ones that are, you know, that are not just in it for the money, that they're passionate about what they're doing. You know, they are aligned with shareholders. They're buying stock in the open market. They're buying stock in the placements. You know, they're raising the money at the right times, and they're focused more on their focus is on less dilution, because this is a capital intensive business, and it's a highly diluted business, because, you know, these juniors that we're speculating in, the ones that aren't growth oriented producers already, you know, they're just burning matches. I mean, they have to continue to raise capital and dilute shareholders and put it in the ground, and hopefully, you know, be progressive in what they're doing, and be attractive enough to attract investors to go along for the ride with them. And that's getting more and more difficult to do as the generalists continue to stay out of the sector, and resource speculators that are already in the sector have been in the sector for a long time. Even some of those are, many of those are getting frustrated and getting out. So A, it presents an opportunity, but B, you have to be super patient, and you have to be in the right companies with your patience. And this is why you accumulate a basket of these things. And, you know, I mean, a lot of these management teams that I'm invested in now, they've made me money in the past. So I already know they have a great track record. I have an established, rapport with them. I'm familiar with them. They've made me money in the past. So I'm going to give them a little more leeway, a little more rope, right? And I'm going to average down in those stocks first, as opposed to companies I'm less familiar with.
Yes, that makes sense. So 8 years ago, when I started, obviously, I didn't have as much technical knowledge as I do now. I have I'm not technically trained by any means. However, back then I was told, find good technical people to vet projects. And if they sign off on the due diligence, investing behind them at the right time could be a smart thing. Now, when you look at this, especially for new retail investors listening to us, there's an exploration company. They put out a good hole, and a major or a big entity in the mining sector then writes a $10, $20, $30 million check. Now, from your historical perspective, how often does that work out well for that exploration company? How much credence should a new retail investor put in that check signing?
Well, it justifies what they're doing. If a major is going to pony up some cash, but remember that take a look at the major and see how much they're putting into it. How much is it in relation to their bottom line? If it's like a Barrick or a Newmont and they're giving them, 20 million or 25 million, that's lunch money to them, right? They're taking a flyer on this, right? But it does give it more credence, and it gives and it justifies what they're doing more to the market. But these guys can pull out also. I've seen it happen before, and it's happened to me before. I came into a company because a Barrick came into it, and they lost patience because it was in the Yukon, and everything in the Yukon, A, it's seasonal. The season's like 5 months. B, the government is super slow. There's not a lot of infrastructure. And this was a company that they got into it and there wasn't any infrastructure. They were flying in to an airstrip and then taking a helicopter to the project. So that's super expensive to explore, and it's super risky, but what they came up with was attractive enough to attract a major like Barrick. And they gave them sizable, I think it was like 20, 25 million, something like that. But then a year or two later, they pulled out because they lost patience, just like any investor would, right? So that's not a guarantee. That's not a guarantee when you see a major come into a stock. But if you do your due diligence on why they came in and see what they see, and if you know the people, it helps a lot also that, hey, this looks like it's justification enough for me. I'm going to take a position and start accumulating because it looks like, and it also depends on what stage they're at also. If it's early stage, it's more risky. But if they're at the feasibility stage, then that's more reassurance to me that, hey, this is something I might like to, I might be interested in.
Excellent. Well, Dave's website is juniorminerjunkie.com. If you're not familiar with his work, head on over there. He has a free email list. He'll email you his Friday night commentary on the gold and junior sector. And if you're looking for more guidance and his specific picks, you can sign up for his service. You'll find information there. Dave, as always, thanks for coming on the show, and I'll reach back out to you about the 3rd, 4th week of December for an update.
Look forward to it, Bill. Thanks a lot for having me on again. Always appreciate it.